Get going.
Okay. I'm addicted to BioFreeze.
I was gonna say it looked like BioFreeze. Ooh.
Surgery has kicked my butt like no tomorrow.
They have a new ointment, BioFreeze, Chris.
Nothing is working right now.
Well, the problem is that if you get the BioFreeze off the shelf and you got to check the percentage, you want the one that's 10%. You don't want the one that's 4%. It's stronger, but you have to look at the percentage on the label in the back, the ingredient.
Because only 4.
I know, but you want the 10.
Shit, I want the one that's 80.
All right,
Are we ready?
we are live.
All righty. Are we ready, Sue?
We are live, yes.
Good afternoon, everyone. Welcome to the Investment Committee meeting for the Public School Teachers Retirement System. Today is June 26, 2025, and I'd like to have a roll call vote, please.
Candace Carter Oliver,
Present.
Christina Bennett,
Oh yeah, she's here. Chris, you here?
I'm here. Can you hear me?
Mm-hmm.
Louis Cross,
Present.
Emily Hubbard, Kimberly Johnson,
Present.
She's here. Oh, there's Kim.
Present. I'm short. Present.
Shanice Johnson, Yvette Levy, Jennifer Orr,
Here.
Bobby Richardson,
Here.
Albert Sanders,
Here.
Doris Walker.
Here.
So we have 8, so we do have a quorum.
Thank you. Thank you, Sue. I'm going to go ahead and turn over the presentation to Sue and Jeff. Jeff, are you presenting or Gwelt is presenting today?
We both will. Do we have Theodore first on the agenda or?
Theodore was first.
Okay, yeah, so we, good afternoon, everyone, and hopefully everybody's staying cool in this nasty hot weather. Today we have a special guest, Theodora Washington from PNC. And PNC, for everybody's recollection, is the new custodian that replaced US Bank a while back. So we thought it'd be a good idea to have Theodora come in and give everyone a refresher on who PNC is and what they're doing for the system, and talk about the finalization of the transition and any other good things for an update. So with that said, I'll hand it over to Theodora.
Thank you, Jeff. Hi, everyone.
Hi.
So much for your time and accepting my request to come and see you all once again. I know the last time I was in front of the committee was probably February or March of last year. We were still in the process of the transition between US Bank and PNC. So at least this time I can positively, absolutely say that we have 100% of your assets. Yay, that was definitely a trying transition, especially with you having a relationship with US Bank for so long. So I just wanted to kind of come in, touch base, just explain exactly, just as a refresher for some of you, and if any of you are new, exactly the responsibility of a custodian bank. What actually is the differentiator with PNC? And of course, I'm going to brag about them because I work for them and I've been around for a pretty long time. So I got to say all the good stuff and introduce you virtually via paper, the team that Sue works with on a daily basis, and just kind of get you caught up in exactly where we are now as far as your account is concerned. You do that? Okay. Move slides. Well, I can do this. Okay. So just click it. You know, Okay. This one's okay. So if we go to slide 1, basically, and let me apologize in advance because I'm very good at paraphrasing. So I'm not gonna go through and inundate you with word for word with what all the slides, because to me, that's rather dull and boring. And I don't want anyone to fall asleep. So I'm gonna just kind of like go through, and please, if you have any questions, just let me know and I'll be happy to answer them. So this first slide basically describes the role of a custodian. They handle all your cash management, trade settlement, security pricing, which basically is whenever we get a statement from one of your managers, we ensure that the price of those assets are updated. And we ensure that all your transactions are processed and you don't have any issues with fraud or anything negative containing the funds that belong to the system. It's pretty much just a safeguard. A lot of banks offer this. Most banks offer this as a custody service, but I just want to get into the differentiator. And Sue can kind of vouch for this. I know that with US Bank, Sue probably had to deal with a ton of different people, but with PNC, that's not the case. So I'm going to get to the next slide and basically talk about our solutions, which is basically a recap of the first slide that I presented, but also just to highlight the fact that there you have an assigned trust officer, which I'll introduce you to her a little later on the spreadsheet, and the role of that trust officer, as well as having a relationship manager that you deal with. So for Sue, I'm her relationship manager. Whenever there's a problem, I tell Sue, give me a call, email, message, whatever it is, and we'll get it resolved ASAP. I have worked closely with Gwelda and Jeff doing the transition of your account, as well as working with Sue. And with me is a trust officer. Her name is Lori, and Lori is amazing, not because I work with her, but honestly, she goes above and beyond to make sure that Sue's happy and stays on top of everything regarding the system. I'm going to go to the next slide and just basically talk about that client experience, which is what really, really makes us stand out. I have some people tell me that they deal with 8 to 10 different people with their custodial banks, but like I said, that's not the case with Sue. She only has 3. So she has me, relationship manager. She has Lori, who's her trust officer. And then we have another person who's actually here in Missouri, because I'm not in Missouri, I'm in Baltimore, Maryland, actually. But the person that's here, Lisa, works very, very closely with Sue. If there's an incident where I can't physically be here to help her, Lisa jumps through hoops to make sure we get it done. So before I go any further, does anyone have any questions about the overall responsibility of a custodian or the customer service that PNC provides? All righty. Isn't this awesome? Just go through it real quick. So another differentiator is the fact that we have a long tenure with custody services. So we've been doing this for over 75 years. We are the 6th largest bank, well capitalized. We have currently, well, this isn't current, this is as of March 31st. We have $230 billion under administration. This is what I was talking about when I said the relationship overall. So at the top, you see is the system, and then me as your relationship manager and primary point of contact. And then working with me is Lori, who's the institutional trust officer. Lisa actually is an investment advisor, but we don't utilize her in that role as far as you all are concerned. It's more so for her to help Sue with any reporting issues or anything that she may need someone to actually sit with her to go through how to do something. She gives her that one-on-one interaction, so she doesn't have to try to figure stuff out or talk to 5 different people to figure it out. We also have a custody support in the background that works strictly with Lori and I. Sue doesn't have to talk to anyone in our trade support team. She doesn't have to talk to anyone in the background. We do all that for her, but they're also part of our team and help make sure that we keep the system's assets safe. Are there any questions about your group of people who work with your account? All righty. So we also, as most custodians, offer reporting. So we have a monthly statement. Sue also gets annual statements. We offer any audit reports, which would be the SSA 18 and SOC reports that a lot of times your auditor will ask for that stuff. It's not anything that you really have to worry about, as well as the ASC topic 820 level reporting. That's also something that your auditor will ask about. What really makes PNC stand out is we have an online portal that we utilize, which is called iHub. I'm going to just give you like a overall kind of example of it. So kind of think of it as your personal banking account where you go online and you pay your own bills. That's exactly pretty much what iHub is. So Sue has the ability to go in, she can send us messages, which is personally my favorite thing because the messages don't delete. So I still have stuff from Sue from last year via iHub, whereas if I had sent her an encrypted email, it would have disappeared within a year. So that's one of my favorite things of it. And then two, it's also an extra layer of protection. So if you turn to slide 7, you'll see exactly what I mean. You'll see the percentages over to the left of where, you know, we have issues with fraud. I can personally tell you about a situation I had where one of my clients sent me an email trying to change the authorized signers list on his account, and it wasn't my client. It was someone acting as my client. Had the same candidates in his speech and everything via the email. I wouldn't have known had I not actually picked up the phone and called the man and said, hey, you know, you have access to do that in iHub. And he's like, I have no clue what you're talking about. So this is definitely an extra layer of protection with that. To make sure, Sue and her team rather, make sure that all of your cash processing goes through this system. Again, extra layer of protection. We're not getting any emails from her about, you know, send a wire here with an account number and all that stuff on it. Everything goes through this system. It keeps it completely secure. Does anyone have any questions about our portal? All right. This slide is just overall our institutional asset management solutions that we offer. By no means am I trying to get you all to give us any additional money outside of custodial services or banking, but I just wanted to give you an overall of exactly what we offer and the clients that we service. So that's just kind of an added slide in there to give you some security and understanding that you deal with the bank that's kind of a broad realm. We're not just strictly dealing with one type of client and that's it. We do have a very large umbrella. We do cater to a lot of different clients. And I just wanted to give you all an overview of what that looks like. So we go to the next slide, which is slide 9. This is the data security. So this just goes back to letting you know how serious we take protecting the system's assets. So we constantly do testing. We have a chief security officer who is like really behind any kind of updated new fraud protections in place. We do daily monitoring, and we also have a board of directors who pretty much make the decisions of where we're going to go as far as any cybersecurity. It's a lot of rules that we have to follow with that, especially being a bank. You know, we have to make sure that we stay on top of all our security in place to protect your assets as well as our other clients. So here on slide 10, I thought would be beneficial to share with the board because this also shows why you guys made a great decision choosing PNC. Again, not sucking up because it's my employer, but just to be completely honest with you that the bank as a whole truly cares for its stakeholders. A lot of money goes into community development. A lot of money goes into, you know, sustaining the environment. You know, all of us have offspring, family members. You want to make sure they still have trees around when they get around, right? So, you know, it's really important to us as well. Community engagement. We have a lot of employee programs. And one of the ones that really stands out that I think would be impressive to you all is we have a partnership with Sesame Street and Grow Up Great. So we actually have employees who go into the schools, they volunteer their time. We work with special needs kids, going to different events with them. So I just wanted to share with you, you know, you definitely made a great choice in choosing a bank who is not just worried about the bottom line. So we actually do put a lot of effort in building up the community, and we also feel that education is important. So here is just to talk about the fact that, and I know it's a kind of a hot button topic right now, but we do definitely feel it's important to have females making decisions within the industry as well. So we support women's banks, women's businesses. We actually, it's funny, we actually have programs on the job where we can become advocates for women, minority businesses. So we literally go through a whole process where you can take a course to understand exactly what that means to be a woman in business or what that means to be a minority advocate. And we have to refresh that annually to like show what have we done on a personal side to actually support everything that we say that we've actually done. And that's something else that PNC offers as a bank. Just lost the black here, Sue. Do you have any questions about our support to the overall community stakeholders and supporting women and minorities in business?
I don't have any questions. I just wanted to make a comment. I was going to ask about community involvement, you know, and commitment, and it's pleasing to see that PNC does do that. I was wondering if that was done locally, but nice to see that there's an intentional effort behind these things. So kudos.
Thank you very much. And I can actually give Sue some numbers, but I'll have to talk to my counterparts that are locally. Because again, I'm not locally here, so I don't really know all that PNC has put into building out Missouri or St. Louis, but I can definitely find out and have Sue give you all some projects that we worked on or who we may have partnered with.
I can interject in that sense. So as an introduction on my day job, I'm the deputy treasurer for the city of St. Louis. And in our office, we have the Office of Financial Empowerment, and PNC is one of our local partners. And so we do workshops through the treasurer's office at City Hall. We also PNC does workshops for children in our College Kids program. They attend all of our local functions when it comes to community events, field day, trunk or treat, deck the halls, all with our College Kids program. And then we also provide lunch and learns with PNC at City Hall. And we also do lunch and learns webinars through our Office of Financial Empowerment with PNC. So PNC is very active on the local level, coordinating with city employees and city and county workshops where we offer them online, from anything from investing, women events, home ownership, credit, and money management workshops. So PNC is a very active partner with the city of St. Louis as well.
Excellent. That's great. Yeah. I was thinking about financial literacy, you know, what we can do for families and high schoolers, and really, you know, capitalizing on the partnership. So wonderful.
And then PNC also has a very extensive relationship with Harris Stowe and students in their business department. So they're very active on the local level.
And I would just also like to see if you guys can provide just what are you doing in terms of the tornado relief here in St. Louis. I think that would be good information to provide to our constituents here, our stakeholders, our teachers, our staff, to show your partnership, not only, you know, with the retirement board, but what you're doing in terms of efforts to support some of our teachers and staff who have been affected by the tornado.
I can provide that. I'm sorry, I'm one of those people, if I don't write it down, I'll forget it as soon as I blink an eye, I'll forget everything, so I apologize for that. Okay, so I'm gonna go on to the next couple of slides. Is just basically to recap, to let you all know what exactly you pay PNC for all of these grand services that we give to Sue here. So you have a minimum, you have a flat fee of 1.25 basis points on all assets. And then we waived our minimum fee, which typically for any custodial client, we have a minimum fee of $25,000, but you all way exceed that with your assets. So it's no need for us to tell you, you owe us $25,000. So that's completely waived. And then again, because of the size of your assets, we've waived our maintenance fee for each individual account. So that's pretty much the end of my presentation. Just wanted to give you all a refresher on what a custodian does, how PNC is different, and how we are influential in the communities, and how we support minority and women businesses. Any questions or comments about anything else? Okay, awesome. Well, Jeff, now back to you, sir.
Thank you. So definitely appreciate that overview, and hopefully this was a good refresher for those of you that were involved in the process, and it was a very long, extensive process in reviewing US Bank and PNC and the others that were involved, and hopefully insightful for those of you that were not involved in that process. And again, I think the key, and Theodora hit it right on the head, is the money's all there, it's accounted for, and it's in being safe kept very well.
Yes,
So
absolutely, absolutely. And we monitor that daily as well. So the trust officer, Lori, it's funny because she's the only person I know who's off of work and she still works. Like she's on vacation. She says out of office, but then you look at it and she's online. I'm like, Lori, what are you doing? Well, I have to check my accounts first and make sure everything is good to go, because if there's a problem, I need to make sure my RMs know. So she's adamant about that. So she's definitely like first thing in the morning online, looking at all the accounts. Her and I both review that, make sure there's nothing out of place. So we look for any abnormal trades. We look for any significant overdrafts, like things like that. We pay attention to all that with your accounts. And then of course, Sue stays on top of it as well. So something's off, she's right there with it, like, hey.
Amen.
And we do have good tools through PNC. I think that's an enhancement where we are able to kind of do these transfers. We do a lot of wire transfers to various managers and cash back and forth to pay pensions. So I think we definitely have more tools available now with PNC.
great. And as a segue into our report, again, it's probably good that not everybody sees how the sausage is made, but when you think about all of the numbers that come into our reports, which again, our reports are extensive, a lot of numbers, but those numbers come from somewhere, and they come from really from accurate reporting from our custodian and making sure those are reconciled with investment managers. And so again, what it's kind of goes unsung sometimes, what goes behind that, because each one of your investment managers has, not only dozens, but hundreds and thousands of securities that underlie their portfolios. And each one of them has different movements and different pricing structures and things that are not, not the easiest for us to just take a piece of paper and write down, hey, this is how you value that. I mean, there's a lot of systems and important structures and people that go behind making sure those things are accurate, and so they can be packaged together and put together in a nice little colorful thing that we show you on a monthly and quarterly basis. So again, a lot goes behind that, and it's a very important service to have, and certainly it's very symbiotic with what we do. So with that said, Sue, if you want to pull up the monthly report, and we have a pretty light agenda today. So we have the May monthly report, and I'll talk for a few moments about the markets, and then Gwelda's going to jump into the actual numbers for the month and for some longer time periods. But this first page is our market overview and the various market indices. And as you can see, and I'll kind of put this in the context of what everybody's seeing on the news lately and within the newspapers, that we've got a couple of significant wars that are going on, and one that we've been kind of pulled into, along with an additional war that's a trade war and tariffs and things like that. And trying to figure out how all of this is going to play into the economy. So the good news of all that is a lot of noise and a lot of things that we say, hey, this causes a lot of concern, but you can see from the numbers that the markets have mostly shrugged that off. And if you take a look at a month like May, the S&P 500, those are the big blue chip stocks that everybody takes a look at and understands a lot of those businesses, but 6% for a month. That's a pretty big monthly move. It's not to say we haven't seen down month moves like that, but really what we've seen is more volatility in single days. So a lot of big down days, but then we get better news that comes behind those days and shores things up, and if you're not paying attention on a daily basis and just look at it on a monthly basis, you say, hey, things look really good. So it's again, things have been on the positive side. So despite what has gone on with the tariffs and trade wars and some of this turmoil overseas, as far as conflicts that we have, that there hasn't been a major impact at this point on corporate earnings. So I think we still have some time to look at that'll tell us how this really plays out for a couple of quarters. The one thing that's become a little bit more, we have seen some data on it are the jobs numbers. So jobs numbers, our unemployment levels have remained really good. And they've been at lower levels, but we're now starting to see some of those jobless claims come in a little bit higher. So it just telling us that it's taking folks that are looking for work just a little bit longer to find a job. So that's the one right now that really the government is, the administration's keying in on, and they're kind of hitting the Federal Reserve really hard with their monetary policy. So the Fed has said, we don't see anything in the data that tells us we need to lower interest rates. Right away, we're kind of waiting and seeing. The president and his administration are not fully on board with that. So what's going on the past couple of days that the markets have been rallying quite a bit? Well, I think it's a pretty high probability that the Fed chairman is going to be replaced, and that's going to happen fairly soon. So he still has some time left on his term, but he can be replaced at any time. And so the president has been looking for folks, and there might be a potential nomination coming up. So that's sort of telling the markets that if that does happen, that's going to be a person that is going to lower interest rates sooner rather than later. So what's being priced into the markets at this point is we probably see 2 interest rate decreases, or the Fed lowering rates twice before the end of the year. Probably one of those comes a little sooner rather than later. So, what does that mean? Why do markets rally? Because when they lower interest rates, that just means it makes it easier for anybody who borrows money to borrow that money, and it makes it cheaper for them to do that. So in particular, large corporations that are borrowing money and have to continue operations, they can do it a little bit cheaper. So that's always a stimulus for the overall economy. So that's why the markets have rallied on that and have really shrugged off a lot of the negatives. Now, some of the other things we've seen in the news is that the new tariffs that have been in place have been printing a lot of money to the tune of $30 billion a month now. So that's big, and it's a great headline. And if we could say we're getting $30 billion out of nowhere and there's nothing on the other end of that, that's great. But what we need to understand is really what there is going to be an impact on that, because again, when companies have tariffs and have to pay more to get their goods here, ultimately they don't suck that up in their bottom line and their profits. They pass it on.
Exactly.
And so and that's the other thing that the administration's been pointing to, of saying, hey, we've put on all these tariffs, but look at the inflation numbers. They haven't moved up. Well, we haven't given it enough time. You're going to need several quarters to see what that overall impact is to inflation. So, and again, from an inflationary standpoint, that's where interest rates are tricky with the Fed. I mean, when you stimulate the economy too much, inflation goes up. And also when you do something like put in tariffs, that's pushing up inflation. But I always, like, inflation's bad no matter what, but I always kind of term good inflation from bad inflation. Good inflation is when the economy is really healthy, people are spending and taking money out of their pockets and buying things. That's kind of the quote unquote good inflation, if there is such a thing. The bad inflation is, again, from its prices are going up, not because people are spending more and because the economy is really healthy, but it's from, again, companies passing on higher prices because they don't want to take a cut in their overall margin. So that's the fear. That's what the Fed has really been hesitant about for lowering rates. So they want to see how this all plays out. Again, not having the crystal ball, other than the market can be a little bit of a crystal ball of saying they think that the Fed chairman is going to be replaced, and we'll probably see interest rates coming down. So short term, that's not a bad thing. So long term, we still have to pay attention to what this means to the overall economy. And how this does end up impacting the bottom lines of corporations and, if they are borrowing money, can they continue to make interest payments on the money that they're borrowing? And if they have to refinance it, at what rate are they doing that? So what does that all mean? And it translates into volatility. So still having, we've had some great past couple of months, but probably fair to say that we can see some down periods coming at us just to bring things back to a rational level. But if you look at the past 12 months or the 1-year numbers for the S&P 500 at just shy of 14%. So it's been a great 12 months to ride out a lot of that volatility. Look at some of the bigger numbers there. Russell 1000 growth, and this is on the 1-year period at almost 18%. So that's that area of the market with those tech stocks. And again, the things we see in the paper every day, the Microsofts, Apples, NVIDIA, really drives that type of index. We have started to see some of the air come out of that area of the market. Again, you can sort of see that in the year-to-date number. So the Russell 1000 growth index is actually slightly negative relative to the total market at 1%, or the line right below that, the value stocks. So those are the things that are, not the high flyers, but stocks that pay dividends and are a little bit more conservative in nature with how they run their overall balance sheet. So those have done good. So there's been rotation back to that. And again, all of that's normal. We tend to see these things cycle. That's why, and Gwelda will show you the portfolio structure in a moment, but this is why we've made conscious efforts with some of the rebalancing and restructuring that we've done over the past couple of years to neutralize those things, to say, let's have some growth, let's have some value, let's have large, mid, small cap international stocks. So it's more diversification in these types of markets is we always want diversification, but this is the type of market that really tells us that this is why we diversify the way we do and don't take a lot of bets, and we stay conservative. And it's a structure that has a very good probability of meeting that actuarial return assumption over time, but does it at a very risk conscious level. So again, just it's been a great ride. We'd love to keep seeing it go this way, but expect probably a couple of bumps along the way. But none of that, I think, derails that that the system has done a really good job how it's been managed and meeting its objectives. So I'll pause there. That was a mouthful. A lot of numbers on the page. Again, the interest rates you can sort of see at the bottom left table on where things have moved from those shorter term, where it says generic 3-month government. That's sort of that base rate risk free where everything starts and gets priced from there. That's higher than where it's been. If the Fed lowers rates, you'll see that number come down a little bit. Mortgage rates, you can see from where we were at the end of 2024. So those are down a little bit. So a 30-year mortgage at the end of last year was about 7.3%. Now it's down below 7%. So again, if we get into this interest rate environment where we're lowering rates, that's gonna should come down a little bit. And we have started to see a little bit of softness overall in the real estate market. So again, still pretty firm, but not as raging as where it was. So again, if you think back about a year ago, and if anybody was in the market for a home or at least paid attention to what was going on with prices or signs going up in your neighborhood, whatever the asking price was, it was never going for below that or asking. It was always getting bid up from that. Now we are starting to see houses sell below the asking price. So still a pretty liquid market. Things are moving, things are still for sale. So still pretty good demand out there, but it's not the craziness where everyone's bidding up these values now. So again, that'll sort of should bring some softness to the overall mortgage market in those rates. So a lot of positives out there, but a lot of things that could be potentially negative that keep that volatility in check. But so far, so good for the year. Again, Gwelda's going to talk about the actual numbers for the system. But again, so far in June is continuing to move in the right direction. So U.S. equities in general are up more than 3% in June. Fixed income or international equities about 2%, and fixed income 1%. So you kind of aggregate those together. If June ends where we're at today, we still have a number that's additive to the positive result that we have so far through May. So And I'll hand it over to Gwola to bring home what those numbers are.
Okay, so if you turn to the next page. Okay, this is your asset allocation page, and just a refresher, the gray bars represent the minimum and maximum that we have in the investment policy for each of the segments of the fund. As you can see, all of them are pretty much within the inverted triangles where you actually are in that particular asset class. You'll see a couple areas where it's off, which is a global multi-sector and Lazard EMD. And that's as a result of all of the changes that were put in place have not been implemented yet. So once those managers are funded, those will all fall back in. So no cause for concern there. We saw a nice run up in market value. As you can see here, the market value at the end of May was 866,449,774. And that is up from the end of April, which was 847,495,668. So the fund picked up a nice amount of dollars in the month of May. You can turn to the next page, Sue. As you can see here at the top of the page, the composite, which is a roll-up of all the managers within the fund, was in line with the policy index, only off by 5 basis points. Fiscal year to date, slightly below. 1 year number, 8%. Not quite policy index, but a nice run up. The 3-year number a little below. The 5-year number pretty much in line with the policy index. 10-year a little below. And the since inception number is not quite 7%, but above the policy index. Now for the month of May, as you can go down this page, you can see total domestic equity was 6% versus 6.34 for the Russell 3000, which represents large, mid, and small domestic stocks, both growth and value. And if you go down that column that says a month, you've got large cap core. We just have an index fund there, which mimics the S&P 500. And the next segment is your large cap value manager. And you can see here, Edgar Lomax, who is a deeply contrarian large cap value manager, did not meet the Russell 1000 value and underperformed in the month of May. But this manager over time, at the very, very end, you'll see there the 10-year number and the since inception number, they're ahead or in line with that index. If you remember what we did in order that we can recapture some of the efficiencies of the large cap value index, we did shave some of the Edgar Lomax portfolio off and invest it in an index fund that represents large cap value. So as a result, it gives you a smoother return stream than having all of your large cap value assets with a manager, so that you capture when that index is performing well, you get some of that. And when that index is off, you have protection on the downside by an active manager like Edgar Lomax. In the large cap growth segment, TCW represents your large cap growth manager, who nicely exceeded the Russell 1000 growth in the month of May with 10.85% versus 8.85, 200 basis points of outperformance, which has brought the fiscal year and 1 year numbers as well as 3-year numbers up. 5-year numbers and 10-year numbers are a little bit more challenged, but a lot of it has to do with, and within those numbers is the Magnificent 7 stocks, where that large cap growth index was very, very concentrated, and the managers will not violate their internal risk parameters in order to chase that. But as you can see, this has actually paid off for them in more recent time periods. So no cause for concern with TCW large cap growth manager. So you can turn to the next page. In this small, mid cap, micro cap area, each of your managers exceeded the return of their respective indices for this month. As you can see here, Westfield 6.7 versus 6.4, Systematic 5.4 versus 4.2, and DFA 6.33 versus 5.34. No cause for concern on any of these managers. If you look at the since inception number, all of them have exceeded their benchmarks in all those periods measured. And if you look at the roll up at the top, with the exception of the 1 year number, this segment has exceeded the Russell 2000 index, which is a small cap index for this particular asset class. And our international, which has been an area for many years, was kind of like not an area where a lot of people wanted to be. Fortunately, the fund is diversified and has exposure to international. If you remember from the first page that Jeff went over, actually international, both the developed markets and the emerging markets have done very well. And as you can see here, Fidelity, which represents your international manager with a growth tilt, 5.4% versus 5.2. Fiscal year to date, this manager has delivered 14.7% versus their benchmark at 12.9. 1-year number exceeds at 10.4 versus 8.03. If you look across the board here, Fidelity has done a nice job and exceeded their benchmark in all time periods shown. Consway is developed value manager. As you can see here, they also exceeded their benchmark in the month of May, 5.52 versus 4.01, slightly off fiscal year to date and 1-year numbers. But the longer term numbers are compelling here, showing a 3-year, 5-year, 10-year, and since inception number ahead of their custom benchmark. Now, if we go down to the emerging markets, which is the lesser developed markets internationally, as you can see here, DFA is also represented here. Their quantitative managers, you can see here, their numbers are strong for the month of May at 5.1 versus 4.3. The longer term numbers are stronger than the 1-year number. As you can see here, 3 years exceeded, 5 years exceeded, 10 years, and 6 inception, all above that MSCI Emerging Markets Index. Invesco has been a bit more challenged. We had them in last fall. As you can see here, they did not deliver as strongly, and we do have a search in play considering another manager in this area, 3.47 versus 4.3. And as I mentioned, the longer term numbers are not as compelling for this particular manager. You can turn to the next page, Sue. This is your global manager of managers, Exponents. And as you can see here for the month, they're pretty much in line, only off by 4 basis points for the month of May. The fiscal year to date number is ahead of that index. Their custom benchmark 5.6 versus 5.32. The 1-year number and 3-year number not quite as strong. Since inception for Exponents is 10.16 versus 10.75. They were hired back in 2020. So we just some short-term weakness within the last year, but a long-term number still of over 10% for that particular manager of managers. If there are no questions on the equity managers, both domestic and international, we can move to fixed income. For fixed income, as you can see, in what was a tough market for fixed income on a relative basis, the total portfolio at the top for the month delivered a negative return of 0.05 versus a benchmark return of a negative 0.27. If you drill down, you see here Manulife and Ernest Partners represent the core fixed income managers. Manulife protected on the downside, delivering a negative 0.5 versus a negative 0.72 for the benchmark. If you look at the 1-year number, Manulife is ahead, 2 years, 3 years, 5 years, 10 years, and since inception, Manulife has exceeded their market benchmark of the Bloomberg Aggregate Index. Short-term weakness for Ernest Partners in the month of May, negative 0.84 versus negative 0.72, but no cause for concern with this manager. As you can see here for the fiscal year to date, 1-year number, 3-year number, 5-year number, 10-year, and since inception, Ernest Partners has also delivered excess returns over and above the Bloomberg US Aggregate Index. Opportunistic fixed income is where we're doing some rejiggering. The Lazard EMD will go away, and we have a couple of the managers that are being funded in this particular area. As you can see here, the Loomis Sayles Strategic Alpha Trust had a good month with a positive 0.97 compared to the custom benchmark, which was negative 0.27. The fiscal year-to-date number a little off, but if you look at the 1-year, the 3-year, the 5-year, and since inception, this particular manager has exceeded its benchmark. The TIPS is just an index fund, which mimics the TIPS index. Neuberger, Global Opportunistic Manager, delivered excess returns or relative excess returns versus their benchmark, a negative 0.06 versus a negative 0.33. Fiscal year date above, 1 year above, a little more challenged in the 3 and 5 year and since inception numbers, but we don't have any concerns here, but we will continue to watch this manager continued improvement, which will bring up the longer term numbers. As I mentioned, the Lazard EMD is going away, but it did deliver a positive return in the month of May. And I believe the next page, the total GAA manager PIMCO below for the month of May, 1.19, fiscal year to date below, 1 year below, 3 year below. The 5 year, the longer term numbers are stronger, with the 5 year delivering 8.27 versus 5.93. 2-year number exceeds, and since inception number exceeds. Hedge funds, the interest is paying out. That's slowly going away. White box, not quite as strong this month, 0.49 versus 1.16. But you look at the 1 year number, the 3 year number, the 5 year number, 10 years since inception, this hedge fund, multi-strat fund, has delivered in excess of their respective index. And Grosvenor, for the month of May, was your best performing hedge fund manager. It's a hedge fund of funds, 2.41. And if you look at all the numbers across the board, this manager has delivered nicely in excess of their index over our time period, all time periods measured. And the next page is real estate, of which we don't have monthly returns on that. They only report on those quarterly. And that rounds out the performance for the fund for the month of May. Are there any questions?
Well, I would like to say great job for the report, and great job to the managers who did well. Is there any managers that we have on the watch list at this time? It seemed like everybody did good. And then also, is some of the numbers low because, like Jeff was saying, because of the trade war?
I think it's a collection of things. I believe the Invesco, I'm pretty sure is on the watch list. Invesco in the emerging markets section, and that's the one that we have a search in play with. I'd have to look back at the quarterly report, but looks like most of the managers this particular month have delivered, and they're starting to pull up some of their return numbers on a longer term basis. Jeff, I have to look back. Let me see if I can pull the March report up. And we did change the watch list criteria so that it was more in line with what we see, which is 3 and 5 year rolling rather than 2 year rolling. Let me go to.
Bobby, with respect to the trade war, while Will is pulling this up, I think we're probably seeing fairly, I'd say, mixed results on who is and is not directly impacted right now. So, certainly, probably some of the international managers might get a little bit more impact. So like Exponence, and for what they're doing on a global basis, probably has a little bit more of that shorter impact, as well as any. I guess if you look at some of the larger cap managers like an Edgar Lomax or even TCW, both of which have had some improvements in performance, but again, a lot of those bigger blue chip companies that they deal with in that large cap area probably have a lot more business and ties into overseas, whether they work with overseas suppliers or other factors, or having to bring product or something that they have to bring it overseas to help them make whatever they're selling or creating, and that's where you probably see the most impact. But again, I think we don't start to see a lot of that for a couple of quarters. So right now it's been all roses. That the tariffs have been good. They're bringing in $30 billion a month, but I think we're probably going to need a little bit of time to understand the other side of that, how much of the pricing is being passed on to consumers, and to what extent that's going to cause a slowdown to anybody buying, Microsoft or an iPhone. iPhone is going to get more expensive because a lot of parts that have to come in are being made overseas and being shipped from overseas. So, iPhone prices will go up, and other things in the technology world will be more expensive. So is that going to cause people to stop, to slow down in what they're buying? So I don't think we're going to fully see that yet. So but again, I would say we're probably pleasantly surprised with how positive some of the numbers have been, just given some of the noise and what's going on with that. And again, when you have a couple of different global conflicts going on as well, one of which frankly should be having a significant impact on oil, but it hasn't. So market's kind of acting on their own.
Right.
Yes, okay, thank you, Jeff.
Oh, Bobby, I pulled off the March report, and of course, this is really old news now because we've started to see the improvement by some of the managers. We had Edgar Lomax on watch, but as you can see, their numbers, with the exception of this month, had started to come back, so they're on watch.
Okay.
TCW is on watch because of some past longer term numbers, but as you remember from the report itself, TCW here, if you look here, they've actually come back nicely through the May period, and it'll be interesting to see, but we should start showing some better, we're seeing some better numbers with TCW, so we see improvement there, so no cause for real concern there long term. Invesco, yes, that's when I mentioned the Invesco Emerging Markets Equity. That manager still continues to have trouble. So that's one area where as I mentioned, we have a search in play. Exponence managers, we have them on watch. They just made their 3-year time frame. The longer term period, 5 years, is not applicable. They haven't been there that long. So I would hesitate to be real concerned there until we get some more numbers, longer term numbers for them.
Mhm.
And in fixed income, we already mentioned Lazard EMD is going away, so no cause for concern there. And Neuberger Berman, they are on watch, but they're starting to see in their 5-year number here, they actually didn't qualify. It's the shorter term numbers for them that kind of hurt them. And PIMCO All Asset, they have on the 3-year numbers were not as good, but their 5-year numbers, they're doing fine. So I think the only one on here that we really are keeping a really close eye on is the Invesco Emerging Markets Equity. And we're going to keep an eye also on the PIMCO All Asset. Their longer term numbers, the 5-year numbers are fine for PIMCO All Asset, but the shorter term numbers, the 3-year rolling, they fail on the watch list. So we keep, Jeff and I, not only do we look at the monthly reports, but we also look at the longer term numbers, which is more indicative of how a manager performs in different types of market environments.
Okay, well, thank you, Gwilda.
You're welcome.
Okay.
Are there any other questions or concerns, or Jeff, is there anything else you'd like to add to the discussion?
Do you want to keep that up for a second? If you can keep that up and go back to the fixed income page. Thanks. Well, I'm going to jump back, and I want to talk about the Manulife structure. So we do have a recommendation we're going to make today regarding Manulife. And before I get there, I just want to go through a little bit of history on the fixed income section. So Gwilda did talk about some of the moving pieces that we have here, but again, just to sort of refresh everyone's memory. So the board did approve terminating Lazard EMD. So that's for that 24.3 million that you see on this report. And that's going to be used to fund Wellington, which is a manager that does a lot of everything. They're more like a Loomis, Strategic Alpha, or Neuberger Berman. They're very global. They're in all of the different fixed income markets.
Yeah.
Very hyper diversified. So that's in process. I know Sue's working with attorneys back and forth for some side letters and other things on the documents to get that funded. So that is pending. And the other big movement that had been approved was to fund another manager, Loop Capital. And so they will be up in that core fixed income segment where Manulife and Earnest are, and they're being funded through $25 million being taken from Manulife. So I want to go back with even a little more history behind that. And when Exponence, who runs a global equity portfolio for the system, also had a fixed income strategy. So for those that remember that, and they had a very large, I think it was an Illinois municipal investor that was one of the largest investors in that product, decided they no longer wanted to have exposure to that strategy, and they wanted to liquidate. And we felt that trying to have them hang on to that strategy and keep it liquid, I think everyone sort of agreed it just didn't make sense to keep that. So we had Exponence wind that down, and they also had some portfolio manager turnover too. So there was a lot of things there that we just felt that made sense to reallocate that. So at the time, we decided to reallocate that to Manulife because Manulife's a bit more of a conservative structure. It's lower cost and was kind of a good place to park the money. But I think our long-term understanding was always we still wanted to continue to diversify out the core fixed income segment. So that it was probably never meant that was going to be permanent. Manulife, so we're going to fast forward back to where we are today. To fund Loop, we had to inform Manulife that we were taking $25 million away. So they came back to us and said, well, okay, well, we can get you the money, but you have a managed account or a separate account structure, which means it's your own account with your own set of guidelines. It has its own custody account through PNC where they track and reconcile and are involved in everything behind that. They said they can no longer do a separate account. And what's usually, well, what are a couple benefits of a separate account? One is the fees are generally a lot more negotiable than, because you can't negotiate a fee with a mutual fund. Some commingled funds you can't, sometimes you can, sometimes you can't negotiate fees. So you usually get the best fees with a separate account structure, but the other primary benefit is being you can create your own guidelines. You can tell them what you want the credit quality to be. You can tell them you don't want them to invest in certain areas of the market. You don't want them to use derivatives, other types of things. So those are really the primary benefits of the managed account. So wherever the system has enough size in assets, we generally do trend towards trying to get a managed account. So some of our equity managers have managed accounts. Some of the fixed income did. But now I think one of the trends we're starting to see in the industry is because commingled fund structures are becoming a lot more attractive and the accounting of them and the liquidity of them has become a lot more popular. A lot of managers are starting to push more investors and size towards commingled investments rather than managed accounts. And for them, it's a matter of scale. If you think about it, if you have 100 different separately managed accounts that have different guidelines, it's much more of a challenge to administrate and manage. So if they can get everybody on the same page into a commingled trust, it sort of helps them on multiple fronts, on an administrative front, and they can aggregate assets to get more favorable trade blocks and cheaper commissions and things like that. So we've really started to see more of a trend. So Manulife kind of jumping on that trend said, well, we have a commingled fund now. We're really not doing managed accounts or separate accounts anymore at $25 million. As they said there, our minimum is 50. So they said, we would like to move you over to a commingled fund. And so that's kind of where we're at. So they don't want to continue to manage a separate account for us at the $25 million level. So, Sue, if you want to flip over now to the Manulife sheet. And I'll kind of go ahead, Christina.
So Jeff, the problem I have is that was that I'm on the phone, baby. I'm on the phone. I'm on the phone. So did we get notice of that in advance? I mean, again, they were happy that we added money on a short term, but did we get notice that was something they were doing industry wide?
No, not really. I think that was just something that once I think part of that is probably, when we did give them more money, I know that we also talked to them about lowering their fees, which they
Mhm.
did. So I think they said, hey, we negotiated some fees for you all on the managed account, and now you took this money away. And so, I think that sort of played into the decision a bit. That wasn't said. That's just sort of my gut feeling on it. So no advance warning other than we said, hey, we have to fund another manager. We're taking away $25 million, and that's what they came back with.
Mm,
Can't see you.
Hey,
I can't see you on focus.
okay.
All right, I think so
There you are.
too.
Okay, let me
now
go
we-
off.
No, we can't see.
Okay, I'm gonna go off camera, but I'll go ahead and let you continue.
Okay, so I'll sort of give you the good news bullet points on this, in that the commingled fund, it's really very similar to the separately managed account. So Sue pulled up this is the 1-page sheet on it. You can see on a performance basis, this is these are 12/31 numbers. I know Will just showed you the 5/31, but the magnitude of the performance relative to benchmarks is very similar. So it's outperforming its benchmark net of fees. The commingled fund is stated to have a fee of 0.3% or 30 basis points. Right now on the managed account, you're paying about 0.26%. So we asked them if we could at least have a fee that was in line with where you are now. They agreed to that. So again, sometimes you can negotiate these commingled fund fees, sometimes you can't. They have agreed to do that. So they're going to give you the same fee that you have now, similar portfolio structure. It's daily liquidity, so and daily valuation. So we don't have to worry about any sort of long-term liquidity issues with the fund. So it's really, you have the same team and the same process, same philosophy. So minor differences in guidelines. So again, the portfolio structure looks very similar, but your current guidelines say that they can actually buy something that's below investment grade. They usually don't. They haven't. It's been a while. The guidelines for the commingled fund say they cannot buy anything that's non-investment grade. And that's fine, because for this segment of the portfolio, we want this to be heavily investment grade. We want it to be core, very diversified. And we let those opportunistic managers do more of the adventuring into things that are below investment grade, non-US, and fall outside of different guidelines. So again, some minor guideline differences, but overall, you're really getting the same look, feel, risk and reward profile, and as important, liquidity and fee are the same. So with that said, and again, we can kind of retake a look at structures, and I know it's always tough when a manager comes back and says, hey, we just don't want to play ball with you on something like this. And if it does sort of put a bad taste in everyone's mouth, we can certainly continue to explore and see if there's other managers, and if we want to do a search. But we would think, at least for the time being, that this is no harm, no foul to move over to the commingled fund structure. So Gwilda and I would make the recommendation to allow them to transfer this over to the commingled fund.
So Jeff and Gwilda, years ago, we had this conversation with NEPC, and that with the higher percentage of funds being commingled,
Right.
And liquidity structures of not being able to liquidate in a downturn. What percentage, and again, you probably don't know this right now, but what percentage of our portfolio is commingled that would restrict us to be able to get out of investments if we needed cash, right? We did this probably in 2008 or 2009 when we were looking at the market took a big tumble, and obviously our pension payments come regardless of what the market is doing.
Right.
And so I know that historically we were creeping up pretty high on commingled funds. Where are we on that percentage in adding another 25 million? What that's going to increase it. But
Right.
at what point do we say we can no longer add commingle funds because it's going to restrict our liquidity, our ability to get cash in a downward market?
Right. Excellent question. And I think a big part of that question is sort of distinguishing between types of commingled funds. So
Correct.
we have in the traditional markets and traditional equities and fixed income, we have a handful of commingled funds, but all of them have, they're all daily liquidity. So, and that's whether it's a mutual fund or a commingled investment trust. They all have daily liquidity, and none of those would have anywhere in their documents something that says that they could gate the redemption. So even for this fixed income manager, if the markets were significantly down, they still have to give us the money. They can't gate the redemption. Now, you have a whole other subset of commingled funds, and all of those fall within the hedge fund, real estate, private equity, private debt categories. And that's going to be maybe to the tune of 25% of the total portfolio that are in things that where you can get gated redemptions, or private equity where the gates don't even matter. That just the money's not there. So
Right.
Again, we've been pretty conscientious with that just by our targets. So remember, for private equity, our target is at 7%. We're about on that. Real estate, same 7%. We're a little bit higher there, waiting for some of that money to come back. And then for the private debt, it's 5%. So those are minimal. The hedge funds, at a 5% target, which is now at 6.3%. Again, if things get really bad, could we get some gates and issues there? We certainly can. We have done some rebalancing fairly recently, and we'll continue to do that on an annual basis to give them fair notice to keep as close in check with that 5% as possible. But I would say with anything in that category, in those privates where we can get gated and don't have the liquidity, we're always conscientious of those targets, and those targets, and sort of going back to that asset liability study that we shared with everybody at the last meeting, that's certainly something we take into account, that understanding what the overall liquidity and cash flow needs are of the system, that we really don't want to go above those current targets that we have in any of those areas. But I think from the other standpoint, again, going back to someone like Manulife and their structure, where it's daily liquidity, their documents will not have a provision in there for them to be able to gate the investments to get them out, that we consider that the same sort of liquidity as a mutual fund or a managed account. And so I don't think we would really have a limit on how many of those we could do.
Okay, that's good to know. I just wanted to double check. It does. Sorry, my peace and quiet has just been, obviously, a tornado has entered the room. So you're making a recommendation for us, Jeff?
Correct. I Sue had a motion.
Okay. So do we have any questions on the recommendation before we go? Hearing none, Sue, do you want to present that? The motion is presented in front of us. Would someone like to make the motion?
I make a motion to recommend a change in Manulife investment to the commingled fund as recommended by investment consultant Mariner.
Second.
It's been properly moved in second. Is there any questions? Any comments? Any discussion? Hearing none. Sue, can I get a roll call vote?
Candace Carter Oliver,
Yes.
Christina Bennett,
Yes.
Rose Cross,
Yes.
Kimberly Johnson,
Yes.
Jennifer Orr,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
All right, so we do have a The motion carries, and then this will be presented at our August 11th board meeting then to the full board.
Sue, do we have any other business, Jeff or Gwilda, on the docket?
That's it on our end.
That's
I
it.
want to thank Jeff and Theodora for being here in person
Yes.
today.
Theodora, I appreciate it.
Absolutely, no problem at all.
Yep. So hearing none, can I get a motion to adjourn?
I make a motion to adjourn.
Richardson second.
Been properly moved in second. Thank you, everyone. Please, all those in favor?
Aye.
Please stay cool. And we'll see you at our next meeting.
Bye.
Thank you.
Thank
Bye,
you.
Jeff.
Thank you, everyone.
Bye.
July.
Bye.
Okay,
Great.
good night, everybody.